where they're actually shortening their horizons. They're actually moving down the yield curve and loaning us money, but very, very short-term loans. So essentially they've got one foot out the door. So there's not a whole lot of comfort from the creditors. There's not a whole lot of confidence from the American people. They've learned their lesson. That's why I think when people talk about trillions on the sidelines, that money is not coming back into the stock market. I think, fool me once. And, I think as we go forward, the unsustainability of the various policies and procedures we witnessed the last 12 months will be reflected in lower share prices. And this is going to be a very lengthy period of time to get through this based upon the government intervention.
Let me ask you, Bill, because last year so many people were crushed, and almost across the board, very smart people, too, who were caught up in the downdraft, and their clients suffered, and in many cases tremendously, and yet you were up 134%. When you sit and watch this reflation effort and watch all of this taking place, it's difficult to time, but you know everything that's happening inside the economy, it's all unhealthy. And it's coming from, or basically stemming from the fact that where we used to, when we had a healthy economy, maybe we could use 66 cents of government money to create $1 of GDP. And what is it today, around $5 or $6 to create $1 of GDP?
Yeah, I think the numbers would be even higher than that, Eric. I mean, the numbers that we're talking about today in terms of new debt piled onto the system and what we're actually getting for this new debt, it's frightening to even examine.
But as someone who really nailed the markets last year and took advantage of what was really a free fall collapse, really in the last couple of years, your firm has done that at Bearing Asset Management. My question for you is, it's difficult to time, but or you seem to be indicating decisively, this is going to roll over. It's going to have a rollover. Timing it is difficult, but what do you see as the next leg down, meaning as they're building in all this irresponsible money printing, or what some would call the Weimarization of America? Are we going to have new lows on the stock market? Or as Mark Faber says, every time we get down there, they'll just print a bunch of money? What are your thoughts? I'm just curious on your thoughts on the next leg down and what that will be like.
Yeah, I think that there's a few pieces to the answer. One, of course, is the financial landscape. If FASB, for example, does not kind of tighten the rules on mark-to-market, and the government allows them to keep a lot of this debt suspended in animation, i.e. stretching it out over time, hoping that they can reliquefy the bank, who knows what earnings numbers will be printed by the banks over the next 3, 4, 5, 6, 7 quarters. We do know that the numbers are very questionable, to say the least. We do know that there's a tremendous amount of off-balance sheet liabilities that have been rarely discussed by the analyst community. So I agree with Mark that the next leg down in asset prices will be met with even more force by the powers that be, but they're losing their impact on the asset markets and on the confidence in the system by the investment community. I think at some point there's so much crowding out, there's so much government involvement in various parts of the market that people don't even want to participate anymore. And that money will actually leave the U.S. and may never return. It could go to a variety of other places where people feel more secure, where they think at least that the odds of getting a return of your principal is much higher than what it is here in the U.S. So I would say that the real economy, actually earnings that come in, will be across different industry groups. If you look at the top-line growth over the last few quarters, there's no top-line growth. So companies have cut about as much as they can cut. So I think that profits come in, top-line revenue comes down. That's why you're seeing a lot of merger activity, because there's no top-line growth. They figured they could try and merge and maybe get pricing power that way. So we're getting this kind of unwinding impact, deleveraging in the real estate market, of course. Of course, that's being offset by the government trying to keep various parts of the economy afloat. But the amount of private sector debt, again, is very large, so it's currently winning out. Now, the stock market gives the illusion everything is fine. We hit Dow 10,000 this week, and everyone has the Dow 10,000 hat on, but we've actually put trillions and trillions of dollars into the system. And as I said earlier, we haven't gotten anywhere. We're still back at Dow 10,000. So I think earnings disappoint, stock prices come down. Now, whether or not this turns into a panic and people just leave the U.S. investment market, that could be a function of a number of things. Additional policies enacted by the government, this health care bill, which may add as much as $400 or $500 billion to the annual deficit. Mark and I agree that the government here will be running deficits of roughly $2 trillion a year. That's not good. And you're going to alienate not just the creditor, but a lot of foreign direct investment in the United States.
I know you had a chance to spend some time with Dr. Mark Faber in New Orleans. You and David Tice were there together. I couldn't make it. I know you guys wanted me to go, and we have David on tomorrow. But I guess my question for you is, because you brought something up here about money leaving the United States. Now, money and capital, Bill, tends to go where there's freedom for the people and economic freedom as well. And as an example, if you look at Hong Kong, I know it's extraordinarily expensive for housing there, but there's a 16% tax on income tax. There's 0%, I believe, on capital gains of any kind, either housing or stocks. Now, as I said, the housing is extraordinarily expensive there, but that's why you have so many billionaires located in Hong Kong. But where you have freedom, Bill, and where you have freedom in an economy, that tends to almost be like a vacuum, vacuuming in funds. And you brought up this point about money leaving the United States. And as we go into a police state more and more here in the United States, and clearly we're losing our freedoms. Everybody knows this now. So we're losing our freedoms. We're moving towards a police state. As you said, rather than the money just going back into the stock market, there's a real possibility then that that money ends up in foreign markets or in other places. Isn't that the very point that you're bringing up here?
Yeah, I think capital's going to flow where it's most welcomed. And the actions taken by the current administration clearly are sending a red flag to investors, I think, around the world. We're going to see tax rates go up in the United States. They're talking about raising capital gains taxes to 20% from 15% on long-term capital gains rates. Income tax rates are going to move higher for folks making over $250,000. And God knows if there will be a set of value-added taxes, other types of taxes on small, medium-sized, even large businesses. So new regulations, which is another form of taxation, the money printing that's going on, the unprecedented debasement of the currency, you're not going to be attracting foreign direct investment under those scenarios. And so what happens with American investors? I mean, do they start looking more and more at markets outside the U.S.? Of course they are. It's amazing when people talk about the gold market and how the gold market's in a bubble, and you ask most people if they own gold or silver, and they look at you like you have three heads. It's fun to talk about, but no one owns any gold. So, yeah, I think that we're not really setting, I know we're setting the wrong precedent for capital preservation here in the U.S., and that's the other thing weighing on the dollar.
I know many of your clients, Bill, are concerned eventually about this police state in the United States, but also the thought of capital controls. And I think basically what you're describing here is that money essentially goes where it's most wanted. And really, in reality, that's not the United States at this point, and it doesn't look like going forward it's going to be the United States. So as money leaves, really in reality, Bill, you as a government have to put in place capital controls or further capital controls, correct?
Well, I think the answer to that question is if you look at the amount of net new debt issuance in the U.S. over the next 9 months, we're going to exhaust savings and pension money, and essentially we're going to have to look for foreign investors to make up the shortfall. And if they're not willing to lend us money, we're going to have to print money and buy our own bonds, which we monetize 50% of the debt issuance in Q2. That's a scary situation. That could prompt the authorities to essentially come in and create a set of capital controls where they don't allow a certain percentage of the money to leave the United States and go into other currencies or other asset markets. So it's very possible if we continue down this path.
A lot of people, Bill, are talking about 1966 to 1982, as you know, and talking about basically the fact that we can trade in a range for a lengthy period of time, work our way through this the same way that we did during that time period. And I think there's a bit of fantasy to that. And I think that you look at that also from the same perspective. Do you not? That that's a little bit of fantasy?
Yeah, I think there's significant differences between the period of time that you referenced, 66 to 82, and the time we're living